Well, the frontline indices gained for the third straight week. We had record highs and the Sensex and the Nifty rallied in trade after the strong GDP data lifted sentiment on Dalal Street today. The Sensex gained over 1,200 points in a single day and the Nifty gained over 350 points, ending at a record closing high. Banking stocks led the rally with the Nifty Bank Index gaining over 2%. On Editors Roundtable today, we track all the action on Dalal Street. We also take a look at India's consumption story. I'm Sonia, and today joining me are my co-editors. We have Prashant, Nimesh, Nigel, also Rahul Arora of Nirmal Bang Equities is with us. Rahul, thank you for joining us. And folks, what a week, right? I mean, there was a little bit of trepidation, but at the end of the week, we ended on a high and record highs.
Well, indeed, boom, boom, for the markets. The bears got knocked off. They were smelling that maybe, in fact, this week belonged to them, but it wasn't to be.
At all. And
I mean, and Friday, what happened, right? As it's today, absolutely 350 odd point surge. And was it, I'm just still wondering whether it's GDP, the 8% number, or something else? Because it came out of the blue, and last 5 or 6 days of that range completely taken out in one day.
So I guess, what happened, Prashant, is if you look at one day before the expiry, the market had become very light. The PCR had moved to almost 0.67. Only 3 stocks were in F&O ban. We started the series technically from a positional point of view on a little on the lighter side. And the FI long position was also, showing a bit of indication that maybe you'll see a bit of rally in the first half of the March series. So that typically played out in today's market. Not like that there was a large buying, that's the feedback that I got as well, that there was no large buying for such a big move. But it was more so of short covering some of the sectors like metals and all.
Yeah.
Like a metal sale was up 10% upper circuit in today's market. So that explains a bit of move that, there was a bit of short covering as well in order of the metal and banking names.
Nigel was making a point on futures, I think, this morning, and somebody else also made that point, that the total outstanding futures open interest, index, stocks, everything combined, it's as a relative to the Nifty, it is the highest, I think, since 2007 or something, 2007, 2008 or something. That the market, to that point about, maybe we started the series light, but as a total outstanding open interest is the highest, and it's a very weighty kind of a market. So, but this market has kind of defied all analysis, all macro, shacro, as they say.
Absolutely, absolutely.
Just kept pushing high.
And Rahul Arora, you've been someone who's been bullish on the market for a while, but up until what level? Do you think at some point now you start to get cautious, or do you think this run is going to continue at least till elections?
So, thank you for having me on the show, Sonia. So, I think if you remember, I was actually on Bazaar just after the last state elections had come out in December, and the Nifty was around 19.5, 20,000. And it was just a gut feeling that the Nifty would rally about 15-20%, and that's what we had discussed. So it was about 24,000 is what I was mentally prepared for by the elections in May. You're practically already at 23,000, close enough. But the point is, and you probably hear this enough every day, it's a liquidity-driven rally, right? And the kind of SIP flows are just mind-boggling, right? And when we keep telling our clients and we keep analyzing this, what is it? 55 lakh crores is the size of the mutual fund industry right now. I think 25 lakh crores of that is equity. And I was watching some analysis on your channel on cash positions after the SEBI circular recently. But generally, on average, we're seeing about 3 to 4% kind of cash positions in mutual funds today. So you're talking about almost 1 lakh crores of liquidities. That's just dry powder, right? So I think if you have a day when the Nifty falls 200-300 points, that's it. Because if stocks are down 10-12%, people are not waiting for those days, of the previous corrections or the previous crises where, good quality stocks would fall 30, 40, 50% to buy in. Here the mandate is to go in and buy, right? I mean, you could have a polycap that's down 25-30% in a week, the next week is bought into. So it's really that swift. So sitting where we are today, can we make a case for the Nifty to fall 15-20% from here? While intuitively it would suggest that valuations should take it there, I don't think it'll go there. There will be these momentary corrections, but I think the kind of money, and I'm not even including the liquidity of insurance companies, AIFs, PMSs, LIC. And one very important point, Sonia, this is going to be a very important month because this is the best month for inflows from mutual fund and insurance companies because tax planning happens, NAV adjustments happen. So this could land up being a very strong month and you're running into elections. So don't be surprised if you see a 4-5% kind of move in the Nifty this month as well as, more flows come in. I mean, you could see, you could probably land up seeing the highest SIP flows this month. So who's to say you won't be sitting 500 points, 1,000 points higher at the end of this month from where we are right now?
Wow, that's Rahul sticking his neck out and saying that, the March could be a really good month. But Nigel, you put together some data for us.
Well, that's right. And I'll touch upon the point about the market-wide total open interest as well. So good point is the global cues are stable. This week you got inflation prints, you got a couple of weak economic data, which is read positively. So you have the US markets that were up and about in trade. The Nifty had gained for the third straight week, which is very, very good news. And in the last 5 weeks, 4 out of the 5 weeks where the Nifty has moved higher. But after a while, for the first time in 5 weeks, the mid-cap index ended in the red. The mid-cap index was down 1% for the week, though the Nifty ended with a gain of close to around 100 points. At one point of time, we were down 400 points. So from the lows, actually, the Nifty bounced up close to around 400 points. What added to the excitement in the, in the markets on the whole, one was expiry-related factor. Second one was the MSCI flows as well. And both of them were on expiry day. And that's what helped the Nifty move up. On Friday, we had the best move on the Nifty in the last 3 months. Close to around, a big move is what we've seen. We haven't seen this sort of a move as well. And the markets took the GDP print very, very well. L&T, the stock for the week itself was up close to around 7%. And that seems to be taking leadership now. Apollo Hospitals, because of the trouble in terms of rates, that stock was down close to around 10%. The factors to track from here on. What we saw in the past week, is it a demo of what we're going to see in March? That is the large caps doing better than the mid caps. That's one point that I'll be tracking. The market-wide open interest, it's the highest that we have ever seen. Let's put all the position together. Market-wide open interest is the highest ever. The Nifty is at par with what we have seen. So that's not so heavy. So, the bigger volatility could come in the broader markets. On the Nifty, it still could be an uptrending market. But you could get these knee-jerk reactions because at the end of the year phenomena. So you'll see NAV propping. But you could also see some HNIs, some treasury groups take some money off the table. So watch out for some volatility in the broader markets as well. Key cues to track for the month of March itself. We'll have the Fed meeting. So let's see what they say out there. There's some FTSE flows that are still pending. And a lot of that could be to the banking names, which could support them because private banks have been underperformers and political developments ahead of the big event, the elections. So those are the cues that I'm tracking. But that point on the market-wide open interest being the highest ever could create some problems for the broader market. So let's hear this.
Rohit Srivastava, the India charts, I mean, he's tracked markets last 30 years and he looks at data very closely. 2 days back, he put this thing out. And I said, and he said he compared it to 2008. He said, well, we are kind of looking at the market, maybe taking a bit of a dip. So I spoke to him today afternoon when the market was up 300 points. I mean, what do you say? It's just you get.
In fact, just to add to your point, Nigel, about all the data you said, after today's close, technically Nifty, Bank Nifty, and some large cap names, including Reliance, are on the verge of a breakout. Imagine if HDFC Bank and a couple of large banks participate.
Boom, boom.
Maybe you'll see, as you rightly pointed out, you'll see a Nifty outperformance after a very, very long time vis-a-vis the mid cap and the small cap. So could be, March could be the month where the large caps relatively outperform and there is a bit of underperformance because you'll see a bit of churn as well, the profit booking, so to speak, towards the March end, books getting added for a lot of HNIs and all. So maybe this is a month where the large caps and the big boys they relatively outperform the broader market.
And the Nifty Bank is still 3% away from its fresh all-time highs. If it gets to the fresh all-time highs, it will surpass even Rahul's prediction. That 4% in March will be very easy gettable because the largest component hasn't really participated. But what else are you picking up, Ramesh?
So, Nigel, as you said, right, we're starting the March series on a very strong note, up 350 points on the first day of the March series. So that's a positive thing to look at for. I was just looking at some global data and the fact that India's allocation in the GEM funds is now at a record high of 18.8%. That shows that, because of the MSCI weight also going up for India, you're going to see a lot of funds shifting from China to India and from other emerging markets to India. And that's actually showing up in terms of weightage as well and in terms of flows as well. So maybe that's something to try going forward. If the FI has 10 large positives in the Indian markets, you'll see a lot of large caps, including banks and all, do well. In fact, last week, we saw the third highest weekly inflows into the India fund. So not only the GEM funds, but even the India funds are seeing a lot of attraction now from global investors to put money into this market. So that's something from a flow perspective, one needs to track it very closely. The other big trend, which is likely to continue in the March series as well, is the PE exits, the promoters exits, as well as a lot of QIPs are lined up in the month of March. Understand, before the April quarterly results, whoever wants to raise the money, they'll have to do it before the window closes for the promoters. So this month, you're going to see a lot of PE exits, a lot of QIPs as well, which will hit the market. So that can actually draw a bit of liquidity in the broader markets. As you rightly pointed out, election is something to track going forward. But I guess the election code of conduct is going to be an important trigger for the markets. And because of that, you will see a lot of PSUs reacting. For example, the OMCs, like a lot of investors are waiting for as to what happens to the OMCs. Will there be a retail fuel cut before the election code of conduct? So that's something, some sectors within the PSUs will react to if there is something to come as far as the policy is concerned. So that's something to track, at least in the first half of the March series.
Okay, well, Rahul, so many cues, right, to watch out for. But what tops the charts for you? And let's talk about individual stocks and sectors, right? Where do you see potential now over the next month or two?
So I think, Sonia, intuitively, like I was saying, short term, it does look a bit top heavy, right? So if you just take the last quarterly results, I think about 45% of our companies saw earnings downgrades. Coincidentally, in the upgrades, the largest were the OMCs, but the reasons for those are by and large well known. But I think if you look at this current financial year, one of the things that's taken a backseat has been road allotments. The NHAI targets have been missed by quite some distance. I think that may sort of pick up. I still think that for cement companies under our coverage universe, there is a case between 24 reported and 26 expected for margins to go up by anywhere between 300 to 500 basis points. So I think earnings growth could be relatively strong there. I think in terms of destocking and all of this oversupply issue with respect to China that has plagued the chemical sector, and there are not too many large cap chemical names in India. There are just a handful of them, maybe not even 5 or 6 that are really large, above 25-30,000 crores market cap. But I think the trade could potentially return here because I think they have gone in for a reasonable amount of price as well as time correction. And I think from the large caps, my biggest call for this year would be banks. I think I'm a little surprised with the way the banks have played out. But I was looking at our numbers for the next 2 years. For most, we're expecting a net interest income growth of anywhere between 14 to 18, 19%. Most of them have very good leverage. I think for about anywhere between 1 to 3% ROAs, you're looking at banks anywhere between 15 to 20% ROEs. And even on return, even if you look at the NPA cycle, that the worst is by and large behind us. As Nigel was saying, I think, if HDFC Bank makes a comeback, you never know where things could head. And maybe we could add gold finance to that as well. I mean, these are 20% plus return on equity companies, Bajaj Finance. I think most of these have underperformed. And I think this could potentially be the one large cap sector which could sort of aid us upwards. But beyond that, I think if you look beyond the index, maybe chemicals and cement look fairly interesting at this price point to us.
Rahul, I wanted to ask you about the OMCs. I recall months before it actually came in focus, you were saying, Nigel, I can't believe that it's trading at these valuations. Given the logic with regard to the free cash flow as a percentage of the market cap, the valuations, etc. The stocks have rallied big time now, and there is that fear now getting into elections. How would you approach these stocks from now? Would you take some money off the table?
Nigel, I remember when SBI was around 500, and I used to say one of life's greatest mysteries is why SBI is at 500 when it's trading at 18% ROE, and it's getting less than half the multiples of private sector banks.
Yeah.
Good to see that SBI has done what it has. But at the lows, it's very interesting, and you will not get too many stocks like this in the market where the free cash flow yield and the dividend yield of companies were higher than the 1 year forward price to earnings multiple, and that was happening to OMCs. It was when you bought OMCs, then it was as good as buying a GSEC yield. It was really that safe an investment. There was no way you could lose capital. And I think I understand, the cons to it. People say it's a regulated sector, elections coming up, what could happen at the pump, so on and so forth. But I think just look at what these companies are doing beyond their core business, right?
Yeah.
With respect to new energy, green energy, electric vehicles, there is a genuine move for diversification. It's something like what ITC did, right, to reduce the impact of tobacco on its books, and so what happened to ITC as a result. But at their lows, with the kind of FCF yield and dividend yield, it was a no-brainer to be buying, these stocks. They're still not expensive. I think, what happens is, we were just discussing before the show started what happened to defense, right?
Yeah.
These stocks went up 8, 10, 20 times. The problem is that once you start from a very low base, even if a stock has gone up 3, 4x, it could still relatively be cheap.
So you'll continue to hold on?
I think so. And as I was just telling Sonia, I think from the last quarter's results, the biggest earnings upgrades for me have, in my coverage universe of 180 companies, have come in the OMC. So why not?
We'll take a quick commercial break here. We're back with Rahul. We'll continue this conversation. We also want to touch upon hospitals because that was a space which took a very sharp knock this week. Stay with us.
The the other big headline was the GDP growth, right? That accelerated to 8.4% in the third quarter, and there were some upgrades as well to Q1 GDP and to the full year GDP. But trends show a slowdown in consumption. Prashant, you've decoded some numbers for us?
Not to pour cold water on the generally optimistic tone, but I just want to take 2 minutes to explain that consumption seems to still lag, right? So numbers, GDP numbers are strong, but it's no thanks to consumption. Now, consumption is about 57% of the GDP, and it's one part which is just not firing. It's all investment. And you know, this is the number which shows you that. Third quarter GDP data, investment growth is 12.2%. And that's gross fixed capital formation. And consumption growth is 3.5%. So this is just this latest number that we got last evening. So what we've done is we've looked at total retail sales growth. So I've picked up data from a report from Spark Capital and the Retailers Association of India. And you know what we're doing is looking at the festive season in 22, festive season in 23, and the last data which we have, which is for January 2024. So look at this. Total retail sales growth in October to November 2022 was 11%, dropped to 7% in the last festive season. And in January, it's come down even more. The growth is only 5%. Now let's actually get into some categories, right? Consumer durables and electronics. It's a steady decline. Actually, it's negative 1% in the month of January. October and November 22 was 18, and 23 was 9% or so. Look at apparel and clothing here. 12.5%, 6%, 2%. So steady decline once again. You look at footwear as a category. 21%, 10%, 4%. These are all very sharp declines as far as important categories are concerned. And pretty much all these categories have sort of listed listed companies which operate. Personal care, 7.5%, 9%, and now 6%. Last two festive seasons, and then the month of January. And of course, jewelry is the last sort of subcategory within retail, 18, 13, and 9. It's all going one way, which is actually lower. The other question is urban sort of discretionary spend also starting to slow down? It's not a new question in that sense because QSR stocks, we all know, have been suffering. Demand's been a little weak, but you know, in the third quarter, Domino's Pizza, we saw the sharpest fall there in order volume since COVID began in 2020. United Spirits, I mean, and also, by the way, this is discretionary spend, right? Liquor volume was down 2%. This is the first drop that we've seen since 2020. And then Nykaa, which basically the number of orders grew 17%, which is slightly lower than 19%, the growth that we saw in the second quarter, in the prior quarter. So that's some data. Now, one obvious kind of culprit here is the weakness in the job market. Again, not something new. By the way, about a year ago, I put a similar kind of piece out. And we've been, I think, in a third year of a broad slowdown as far as the consumption space is concerned. So IT sector has shed about 64,000 jobs in the last 5 quarters versus about 3.7 net addition in the prior 5 quarters. Now, IT jobs, for the longest time, for the last 2 decades, have been a source of consumption growth, right? These are well-paying jobs, broadly speaking. And of course, the Naukri Jobs Peak Index is down about 15% since March of 2023. This is a barometer of sort of online hiring. And there are some other factors as well, perhaps, which are at play. And I think managements have alluded to this. I remember we were speaking with Mr. TTK Jagannathan of TTK Prestige, and we asked him why some of his categories are not doing, I mean, it's not looking strong. He said there is a slowdown. It's not as strong as he'd like it to be. And he kind of said one of the reasons could be that people are spending in other areas, travel and hotels, for example. And that ties in. For example, in the third quarter GDP numbers that we got yesterday, one of the few categories which actually subcategories which did very well is tourism as a space. And of course, interest rates are higher. We are all waiting for interest rates to come off, but that is maybe one other reason. So consumption, important, more than half of the overall sort of GDP, still struggling. The hope is that it will also start to pick up because what otherwise happen is that the other part of the market, which is investment, infrastructure, etc., people are going to crowd in, not just in terms of investment opportunities, and that kind of takes valuations unreasonably higher. Rahul, any thoughts?
Let's stick to the positives, I think. I understand, you know, the good part, of course, Prashant, is that the external sector is holding up. I think the converse to is you have a stable rupee, crude's between 75 to 80. and you've now got upward projections to GDP. I think net of all of that, I think I understand that tech sector. I mean, this is very similar to what's happening in the US. I don't know if I think one of the town halls that Elon Musk did recently, he's like, I'm not finding people in manufacturing. He's like, I don't understand what's happening on the tech sector, but he's like, our manufacturing side of the economy is doing really well. So I think it's in some ways it's playing out here, but. I
on
think
consumption, Rahul.
Yeah, I was just coming. I think
Yeah.
the way India is consuming is changing, Prashant. I mean.
But textiles,
so
I mean,
if you-
apparel, footwear, I mean, you.
I know, but if you look at mass, it's out of flavor completely. I mean,
And
just
look at high-end consumption, right?
Yeah,
I mean, that's doing so well.
if you had told me a year back that Indian hotels would be at 600, I would have said you're
So
joking.
you're saying the last point that I mentioned, which is, I mean, travel,
Exactly.
tourism, hotels,
so
that's the
Luxury.
space which is.
I'll tell you, and maybe this is, a study you guys can do independently, and I'm just anecdotally, and this is just, it may not be a very large sample size, but a lot of youngsters I speak to, say between the ages of like 15 to 25 today, don't want to own a house, don't care too much about cars. What do they want to do? They want to travel the world. They want to stay in good hotels. They want very high-end electronics. So maybe the way India is consuming is different. And we're sitting in central Bombay and Lower Parel, and we're trying to gauge what's happening in rural India. Maybe that's playing out. Like look at V-Mart retail, right? Almost 70% of its stores are in UP, Bihar. But on the other hand, Zudio of Trent is doing so well. Trent is hitting a new 52-week high every week.
Yeah.
So I think the way India is consuming. So when you say consumption is slowing down, as a headline, I may not agree with it. I think the way India is consuming is changing.
changing, yeah.
And to that extent, I think.
But I'll tell you, consumption, which the CSO uses to, I mean, it includes everything. I mean, consumption growth, CAGR, this is a 4-year CAGR, and this number is as of 2023. The gap between consumption and investment, and this is GDP, I mean, so this includes everything, new consumption, old consumption, all kinds of consumption. The gap is about 5 percentage points. So there is and it's not just this year or the last quarter, etc.
So let me
I
reverse
take it-
something.
yeah.
Let me reverse something back to you, and maybe your viewers might find this educative at some level. Forget 1 year, 2 year, 3 year. Just let's look at 10 years of Hindustan Lever, right? Till the last concluded financial year, FY23. We still got 1 quarter to go here. Over 10 years, Hindustan Lever's top line has compounded by 8.8%. This includes volume growth, pricing, and premiumization. So what would the volume growth have been over a decade? You've gone through cycles. You've gone through DeMon, RERA, GST, everything.
So what are you saying? You're saying good or bad? Is it
no,
good?
I'm saying that maybe the process of the change of consumption started a long time back. And I don't think staples...
And it's not factored into
Exactly.
the CSO
I mean,
assumptions.
Look
Yeah.
at foods. I mean, are you seeing slowdown in foods? Look at the numbers that Tata Consumer, Nestle, and Britannia are giving you.
Food
They're
is the
so
category
different.
which is doing well.
Exactly. So I'm saying just what kind of consumption is happening. I mean, within QSRs, you highlighted QSRs. Just plot a 5-year same-store sales growth of Westlife versus Jubilant. You may be surprised that Jubilant, despite being a delivery model, has far more inferior, same-store sales growth to Westlife, which intuitively should not be the case because within that you had 2 years of COVID.
Rahul, they're shouting at you to take a break, so we'll do that. But good points, and thanks for that. We'll take a quick commercial break.